Dear students, today we have discussed about the financial markets. The first we can see the introduction. Financial markets are important components of Indian financial system. It means that this is also one of the important part of the financial system. The main aim of a financial system is create link between savers and investors. Investors. It means this is the link between the both means the savers and investors and users. It facilitate expansion of financial markets over phase and time and promote efficient allocation of financial resources for productive purposes. It means that the financial market is the one of the important components, and it helps to the who need the money and who surplus the money. It to be used for the purpose of productive purposes. Now we are going to see the financial market. A financial market is an institute or arrangement that facilitates the exchange of financial instruments. It means that financial market is the arrangement or it is an institute. It helps the exchange of financial instruments. Financial markets are arrangements for helping buying and selling of financial assets or securities or financial claims. In other words, financial markets are the centers which provide helps for financial transactions, that is, for the creation and transfer of financial assets or claims. In short, a market, financial market is a market where the financial instruments such as financial claims, assets and securities are traded is known as financial market. It means that the financial market is a arrangement or institution. It helps for providing saving and investment. The savings are used for the productive purposes. This is the meaning of financial market. Now we are going to see the objectives of financial market. The first objective is mobilization of savings. The mobilization of savings means the collection of savings from different sectors of the society. It means where the surplus fund is there, that is collecting from the society. The society, it means the household individuals, business firms, public sector units, central government, state government, business firms, public sectors units, and local government or state government, etc. This is the main objectives of a financial market. It means that this is the primary object of financial markets is mobilization of savings from the savers or surplus units. And the next number 2, investments. The investments means this is also one of the important object of financial market. It is relating to the investment. The investment means the savings so collected in those units which are in need of the same of productive purpose. It means lending to capital formation. Investment is more important for the purpose of the economic development of the country. Without investment, we cannot have the growth of country. And the third one is entrepreneurial growth. The another object of financial institutions is to contribute the development of entrepreneurs by making available the necessary financial resources, etc. It means that the financial market is effective and efficient, and it helps the entrepreneurs growth. And the next number 4, industrial development. The another objective is to enable the different components of financial market to help and accelerate growth of industrial and economic development of a country, thereby contributing to raise the standard of living and well-being of the society. It means that when the industrial development, the automatically the economic development of the country. When the economic development of the country, automatically the employment, and when the employment is available, the income is increasing. When the income is increasing, the standard of living is increasing, and that is why the industrial development, it is possible only for the effective and well system of financial market. The last one, national growth. The financial market at the contributing to the nation growth by ensuring and unprotected flow of surplus funds to deficit units and for productive purposes. This is also one of the objectives of financial market. Now we are going to see the functions. Financial market perform 2 types of functions. Number 1 is intermediary functions, and next number 2, financial functions. Intermediary functions. The intermediary functions of the financial markets are as follows. Number 1, transfer of resources. The financial market facilitate transfer of resources, that is funds, from savers or lenders to ultimate investors or borrowers. It means the transfer of fund one person to another person or one institution to another institution. in the form of savings. And number two, enhancing incomes. Financial markets enable savers or lenders to earn a regular income in the form of dividend or interest on their surplus investable funds. It means contributing to the enhancement of the individual income as well as national income. And next, number three, productive use. The financial markets helps in the productive use of funds borrowed, thereby raising the income level of the people and the gross national production of the country. And next, number four, capital formation. It means the financial market, it helps the capital formation of the country. It means that mobilization of savings, and that savings are used effectively and allocate efficiently among ultimate user of funds, that is investors, and thereby aim to capital formation. Price determination. Financial markets provide for the determination of the prices of the financial assets like shares, government securities, bonds, mutual funds, units, debentures, etc. An interaction of buyers and sellers. It means the prices is determined on the basis of the buyers and sellers. It means the funds available in the market. And number six, marketability and liquidity. The financial markets provides for a mechanism for selling financial assets by investors whenever they are in need of money or cash, and thus ensure ready marketability and liquidity for the financial assets. And the last one, information. The operation of the dealers in the financial markets lead to the generation and consequent dissemination of market information to the various segments of the market with view to reducing the cost of the transaction of financial assets. And next, second one, financial functions. The financial functions of the financial markets are as follows. Number one, provision of funds. The financial market provides funds to the investors or borrowers so as to enable them to carry out the financial activities. And the number two, provision of earnings. The financial market provide earning asset to the lenders or savers so that they can earn wealth by deploying the assets in productive projects. Provision of liquidity. The financial market provide marketability and liquidity to the financial assets in the market so as to facilitate buying and selling of these assets. Now we are going to see the classification of a financial market. Financial markets are classified into three. Number one, money market. Number two, capital market. Number three is forex market. The forex market means foreign market. And another method of classification of financial markets. Financial markets before independence and establishment of RBI, Indian financial markets are classified into two classes. Number one, organized market. Number two, unorganized market. Now we are going to see the organized market. Organized markets is the financial market where there is high degree of institutionalization and instrumentalization and regulations governing the financial dealings and which is subject in strict control of RBI and other regulating bodies. It means that these markets are controlled by some regulatory authorities. The regulatory authorities means the Reserve Bank of India, SEBI, government regulations. These are directly controlling the organized market. And next be unorganized market. It means that it is a market where there are number of individual bankers, money lenders, private finance companies who lend money to the public. Those dealings are inadequate and not standardized, and those activities are not controlled by the Reserve Bank of India. It means that the unorganized market is not controlled by the Reserve Bank of India, and these are also part of the Indian financial markets. Now we are going to see the constituents of financial markets. It means what are the financial market is included. A topical financial market includes the following constituents. Number one is primary market. Number two, secondary market. Number three, money market. Number four, capital market. Number five, debt market. Number six, equity market. Number seven, financial service market. And number eight, depository market. Number nine, non-depository market. Now we are discuss one by one. Number one, primary market. It is a market deal with the issue of new securities. It means that this is the market only transacting or only trading the new issues. The new issues means the first time issue to the market. It is called as a new issue market. This is the primary market. In this market only the new securities are traded. And the next number two, secondary market. It is a market deal with the existing securities. It means that this market is only already existed security in the market. These securities are traded, and that is why called as a secondary market. For example, secondary market, it means the stock exchange. The stock exchange is always the buying and selling of existing securities, and that is why this is the secondary market. And next number three, money market. It is a market deal with short-term securities. The money market means it is a market deals with short-term securities. It means the securities are deal only the short-term period. It means short-term period within a 1 year. Within a 1 year. And next number 5, debt market. The market where the funds are borrowed and lent. Funds are borrowed and lent is known as debt market. And the number 6, equity market. A market where ownership of securities are issued and subscribed is known as equity market. It means that a market where ownership of securities are issued and subscribed is known as equity market. And next number 7, financial market. The financial market which provide the financial services like ATM, credit card, etc. is known as financial service market. The participants are commercial banks. Number 8, depository market. What do you mean by the depository market? The constitute which accept deposit from the public. It means the institutions which accept deposit from public and lend in the form of loan is called as depository market. Example, commercial banks, mutual savings banks. And next number 9, non-depository market. The non-depository market means these institutions do not accept deposit but they are carry out various functions in financial market. For example, mutual funds, pension funds, insurance company. These are the classification of financial markets. And now we are going to see the meaning of money market. Money market. This is the one of the important market. It means money market is a market for borrowing and lending short-term funds. It means that this market is relating to borrowing and lending short-term funds. It is a market not for money but for near money. It is a market where financial assets and securities which have a maturity period of up to 1 year are bought and sold. In other words, it is a market for purely short-term funds. Now, money market is a market for short-term loans or financial assets. It is a market for lending and borrowing short-term funds. As the name implies, it does not actually deal in money or actually cash, but it is actually deal with substitute for money or near money like trade bills, promissory notes and government papers drawn for a short period not exceeding a year. These short periods instruments can be converted into cash immediately without any loss and at a low transaction cost. Money market is a center for dealing primarily in short-term financial instruments. It meets the short-term needs of the borrowers. It provides cash or liquidity to the lenders. Now we are see the sub-markets of money market. Money markets not a single market, but it is homogeneous market, but it is composed of several sub-markets such as call money market. Number 2, commercial bill market. In commercial bill market, discount market and acceptance markets. And third one, treasury bills market. And next, short term loan market. These are the sub markets of money markets. We can discuss these sub money market in the next video. Thank you one and all. Now we are going to conclude this discussion. Thank you one and all. Thank you.